My name is Jennifer Becker, VP Business Development here at FAIRWINDS Credit Union from our Retirement Planning Department. We will be offering several of these webinars in the coming months, so be on the lookout for those in our member savings email. Now, September is Life Insurance Month, and today I have Kevin Massey, VP Retirement Planning and Financial Advisor with us to discuss life insurance.
Good afternoon,
Kevin?
Jennifer. It's good to be here.
Thank you.
Thank you to everybody out there in attendance. We hope to cover quite a bit today and hopefully give some good information so folks can maybe explore this a little bit further. And it's always recommended if they are interested in anything like this, that they go meet with an advisor, whoever that might be. And as long as somebody is looking at their entire plan, they should be able to advise them well on what to do potentially in the life insurance area.
Awesome. And just a little background on you. You actually came from a life insurance company many years ago.
Correct. I've been a financial advisor since about 2002. And one of the first companies I worked for, we did a lot of planning, and we used a lot of life insurance products with that planning, whether it be estate planning, asset protection planning, or just wealth building. But the cornerstone for a lot of those plans was permanent cash value life insurance, which is one of the things we will be talking about today. So yeah, a lot of knowledge there. And of course, once again, it is important if anybody is interested that they explore this further, because everybody's situation and case is going to be different. It's not for everybody.
Of course, of course. All right, so as Kevin said, we are going to discuss life insurance and how to actually enjoy life insurance while living and supplementing your income. So a couple of the things that we're going to go over is who needs life insurance, who may need the supplemental income. You think everybody does, but there are certain people that would need this. How will your savings be taxed? How can life insurance provide both protection and tax-free supplemental income? How can life insurance provide for long-term care? That's a huge topic these days. What does it mean to use life insurance as a cash reserve?
So those are all great topics, and what we'll hopefully be able to do when people finish with this seminar is they're going to be able to answer those questions. And one of the first things people usually ask is, who needs life insurance? And it's going to be different for everybody, but typically what I will say is that anybody who's in some type of committed relationship, whether that means owning a home together, whether that means being married or fiancés, business partners, or anybody with children, needs to discuss life insurance. And at its most basic, it doesn't even matter what type of life insurance it is. If we're looking to protect a family, for example, it's more important about how much protection they actually have as opposed to what type. But today's purposes, aside from just a death benefit, we're going to be talking about life insurance as a savings vehicle. But for the most part, if it's a young person out there listening and they've got kids or they're married or they're in a committed relationship in some way, it's more important maybe that they just put term insurance in place and get as much that actually fits into. If they're getting a little bit older, typically we like level term insurance. But for today's purposes, we're going to be talking more about using life insurance as a living benefit, life insurance with cash value benefits, and we'll be focusing more on that today. But ultimately, it doesn't really matter what type of insurance you have. It's important that people have some type of life insurance based on their circumstances.
Right. So anyone that would need to qualify or need life insurance would need to qualify for life insurance as well, medically and financially, is my understanding.
Yeah, absolutely. I mean, I have met with people in the past and, they've gone to the doctor a few weeks before, and maybe they got a diagnosis or maybe they got some information that they weren't happy with, and all of a sudden they were calling me wanting to get life insurance. And the problem is, at that point, it might be too late. You have to, basically qualify medically for life insurance. And, that's not always the case. So yes, any type of life insurance requires usually some type of medical underwriting. And that's why putting life insurance in place first, while we're healthy and able to get it, is important. But there are different types of products out there, even for people who maybe have had some type of health setback. And there's even a waiting period sometimes. So if somebody has had, let's say, cancer or a heart attack, very often they might qualify for life insurance 5 years later if they've been symptom-free. But yes, being a non-smoker helps, being healthy, all of that will factor into your cost and whether you qualify for life insurance.
Okay. All right. Well, now who actually needs this supplemental income? I know I could use some supplemental income.
We all can use supplemental income. The way I used to position life insurance as a savings tool would be if we're saving and investing in other areas. If somebody is a super saver and let's say they're saving 10 or 15 or 20% of their income, they're the ones who can really benefit from cash value life insurance as a supplement. And they can use this as a tool while they're accumulating their assets, while the money's growing. And if it's properly funded and if it's a good policy, when they retire, they can very often repurpose that life insurance at retirement for something other than a death benefit. And they might be able to actually use that death benefit or use the cash value for tax-free income. They might be able to use it for estate planning purposes. They might be able to use it, as we talked about, for long-term care strategies. So there's a number of different things, but we all need more options, more income options at retirement. And it is arguable, but many people, many books have been written about the fact that if you can retire with life insurance that's paid up, it can be the key to unlocking some of the other assets and spending and enjoying those other assets while living. And we'll touch upon that a little bit today.
Okay. Well, I have a slide on the screen right now, and it's just a little bit about income needs, really in retirement. What type of lifestyle are you going to have? How is inflation going to impact your savings? How will taxes affect your savings and things like that? So we'll talk about those in a couple of minutes.
And the key is, I think, with that is there are strategies with life insurance where we can maximize a person's income in retirement, and that's really the goal. Mm-hmm. We want to obviously put away as much money and grow our money over time so that we're reaching our wealth potential. And it's going to be different for everybody.
Right. And now that you said it's different for everybody, I do have a little slide on the screen. Talks about you need about 75% of your income. So if you're at 100,000, that's 75,000. If you retire at age 65 and you're actually going to live to 95, I know my grandmother is actually in a nursing home right now. And I had the opportunity many years ago to sell her long-term care. Okay. She did not buy it.
Boy.
So my parents are struggling with it now. But if you live to 95, you're going to need at least $1.5 million of income, or not of income, I apologize, of savings to fund your retirement.
Yeah.
So this is just a general rule.
Very general, because there could be people who have pensions. They're pension rich, but maybe cash poor, but yet they have guaranteed incomes for life for the two of them. But I do like that rule of 70 or 75%. If someone's making 100,000, the year before they retire, if they can retire with combined income of around 70 or 75,000, they're debt free, they're going to have a very, very comfortable retirement. If somebody's making $1 million a year, if they can have 700,000 coming in, then maybe they're maintaining their lifestyle. That would be a good problem to have. But life insurance definitely can help supplement.
Okay, good. Well, we're going to talk a little bit about a couple of different options that retirees have. So number one is Social Security. Again, there is an earnings cap of about $128,000. So if you make more than $129,000, you still you get the same Social Security benefit. The average retiree weekly benefit is about $1,400 a month, which is based on the average income.
Yeah, typically I'll see that number about $1,400 a month, maybe $2,000 a month, just depending on what their income was. I'm not one of those, and I've had experts, there's a lot of naysayers, the media, all that. Social Security will be around. They may have to tweak it a little bit, but I do think for the most part, as people are planning for retirement, that they can count on Social Security being there in one way, shape, or form. And of course, we know you can take it as early as age 62 right now. There's no need to wait beyond age 70. But as part of the planning, when we're looking at the big picture of retirement, some people may take it at 62 and some people might take it at 66 or 70. It just depends on their circumstances, but it'll be there in one way, shape, or form. We may have to raise taxes a little bit in the future to keep it going and to pay out those benefits, but it'll be there, and it's something I think people can count on.
Okay, well, that's good to hear. Pension plans. I heard you mention pension plans earlier, but we are noticing a decline in our membership of people who actually have a pension plan. Can you talk a little bit about pension plans, Kevin?
Yes, and we know they're disappearing. Many people, previous generations, that was their retirement, was their pension. They worked for a company for 40 years, and they were well taken care of in retirement. But we know that since around 1980, pension plans have been going away. They've been changing. People have been getting lump sum rollovers instead of pension payouts. And more and more folks are realizing that I need to save more. I need to put more money away. I need to have strategies in place. I will talk about millennials a little bit, and you and I both have young children, well, young adults, children. I have a son who's 24 and a daughter is 21. And I will say the millennials, they know they don't have pensions. And young people, I'm getting so many children of clients coming in, they're 20, 21, 22, and they're starting to invest already. And I think one of the reasons why is because they're able to use their smartphones. They can see their money building and growing. But it's maybe the previous generation, maybe the Gen Xers who were kind of in between this pension, no pension, who maybe need to play a little bit of catch up and are realizing now, hey, I don't have a pension like mom and dad did or grandma and grandma did, and I need to start putting money in a 401k or putting money into mutual funds or stocks, bonds, or cash value life insurance if that fits the picture. So yeah, we got to do more planning.
Good to know that. Now inflation, the purchasing power of money. How does this play into like that retirement planning ability? Does that mean I'm going to need more when I retire?
Well, we want to have as much income coming in as possible in the future. And there's a couple of different schools of thought that when somebody retires, that they start taking an income, that they build a cost of living increase each and every single year. And there is absolutely nothing wrong with that type of planning. However, if you really go back and study how people spend their money, most people will spend more money and need more money in their first decade of retirement, let's say from 62 to 72. And they'll spend more money during those years than they do between 72 and 82. They'll spend more money in their 70s than they do in their 80s or their 90s, unless there's a health reason. So very often, while inflation is there and we need to plan for it, it's also important to plan for the bucket list years, maybe that first decade of retirement. And I have had some clients who have retired, let's say 62, and they've actually cashed in their life insurance and they use that for their bucket list. And then going and traveling and maybe taking the family on trips during those first 10 years or so of retirement, hopefully 15 or 20. But, taxes are, as we know, kind of that necessarily evil. And we can't predict what taxes are going to be in the future. However, if current tax laws stay the same, meaning if Congress doesn't make changes, it is a good, wise choice to have money in different buckets that are taxed differently. For example, I've met with people where they put their entire savings into a 401k plan, where they've used pre-tax dollars to build up their nest egg. When they retire, they can't do any tax planning. And the reason is every dollar that comes out of a 401k or IRA plan will be taxed as ordinary income. But what if that individual could go back in time and they put half of their money into the 401k, but maybe they put the other half of their money into a Roth IRA or a Roth 401k, or, depending on their circumstances, cash value life insurance. And with a Roth IRA, Roth 401k, or cash value life insurance, those monies can be pulled out tax-free. And there's different strategies to do that, particularly with the life insurance. But this way, you can actually play the tax game in retirement. So if we have an administration that comes into power and they raise taxes, well, you know what, for those 4 years, maybe we pull money out of the tax-free or tax-advantaged products. If we have an administration that comes in and they lower taxes, well, you know what, for those years, we want to may pull money out of the 401k or from taxable accounts. So this way, while we can't predict the future and we don't know what taxes are going to be, at least we have a strategy in place where we didn't put all our eggs in one basket, and we can play a little bit of the tax game in the future. And I think our accountants will be happy if they can save us some taxes in the future. But right now, we really don't know. But we do know if we look at the screen, IRAs and 401ks, those are going to be taxed as income. Stocks, bonds, those are a little bit different if they're not in IRAs. Those we pay a little bit of tax along the way on dividends, interest, capital gains, but we have access to that money. Annuities, those grow tax deferred, but when we pull the money out, any growth that occurred over 5, 10, 15, 20 years, we're going to pay tax on the growth. Life insurance, if we cancel the policy, we will pay tax on the growth, not on the basis. But if we pull the money out of life insurance as what we call a loan or to basis and borrow, we can get away with not paying any taxes on that withdrawal. And that's a little more of an advanced conversation, but something that certainly can be explored.
Okay, well, good. So life insurance, permanent life insurance has these specific tax benefits. Can you talk a little bit about maybe the death benefit, how that's taxed typically?
The Congress and the government realizes that life insurance in general, whether it's term or cash value, is a very important tool for the community. I mean, how many times have we seen on Facebook where somebody in the community passes, maybe it's a husband or wife, and maybe all they had was $50,000 of life insurance through work. And what are they doing? They're doing car washes and fundraisers, because they had children. And if they had just met and put some type of life insurance in place, those things wouldn't be needed. And how much can a car wash really generate for a family? $5,000 maybe. So ultimately, life insurance, whether it's term or cash value, is a very good tool for families, businesses, the community. And the government recognizes that. They encourage people to take out life insurance, and the benefits are 100% tax-free.
All right. And then, again, like 401ks and IRAs, there's contribution limits.
Correct.
Whereas life insurance, there are no real contribution limits. And there's no income limitations as well. So that's kind of nice, right?
Correct. So when people start to become super savers and they're maxing out their retirement assets and all that, cash value life insurance can work as a very, very good holistic financial tool. I used to call it the Swiss Army knife of financial products. And what I mean by that is, let's say somebody is putting money into a cash value life insurance product. It's important for people to think of life insurance. It is not an investment. There are life insurance products out there where you can have mutual funds inside of it, but those typically, they're very complicated and they're not always best for people. Insurance should really be insurance. So I'm a fan of whole life insurance. But think of it as a savings tool that comes with a death benefit. So if somebody's putting in $5,000 a year into life insurance and their death benefit is $150,000, it's a savings product that is self-fulfilling, meaning if somebody gets hit by a car, all of a sudden, and they only paid $5,000 into this life insurance product, $150,000 comes to the family. But what if that $5,000 went into a mutual fund and they get hit by a car? The family gets $5,000. So it's a product that can fulfill itself. It's a contract. If somebody becomes disabled and they put something called waiver of premium on this whole life insurance savings tool, while they're disabled, that $5,000 will be contributed into their cash value life insurance, even if they're not working or unable to work. So it's a product that, once again, fulfills itself. It fulfills the promise. And along the way, it can be used, as we're going to talk about a little bit more, it can be used to borrow against. It can be used to buy real estate. It can be used for many, many different purposes. But think of cash value life insurance as a product like a Swiss Army knife that can do many, many, many different things. But ultimately, it's a savings tool that comes with a death benefit and sometimes a disability benefit and a loan benefit as well.
Awesome. All right. So how can life insurance provide for both protection for your family, like we've talked about, and potentially this tax-free supplemental income? That's the next topic. And I don't know if you want to talk a little bit about that, but the way life insurance works, obviously you pay in a premium or an amount monthly, annually, or maybe even a lump sum, right? And then that amount builds a cash value after the fees for the actual life insurance are taken out. And then, like you said before, like at death, obviously you've got a life insurance benefit. But during retirement years, when your insurance need is reduced, you can actually take access to this cash. So I don't know if you want to talk to that a little bit, and you may have already a little bit.
So the largest life insurance policy I ever put in place was a cash value life insurance policy where the person was putting in about $100,000 a year. Now, naturally, this was a pretty well-heeled individual, and they were using it for many asset protection purposes. But when they retired, or when a person retires, whether there's $100,000 in the life insurance cash value or $1 million in there, it doesn't really matter. That money can be repurposed. I've seen some people cancel the policy. They get rid of it, they take their cash, they pay some taxes on the growth, and they use that money for whatever purpose. I've seen some people annuitize the cash value of their life insurance, where you can actually take your cash value and get a guaranteed income stream for life. That's another option. I've had some people donate their life insurance. One gentleman who donated his life insurance to Notre Dame, and he got some other tax benefits and some income from that as well. But what most people will probably do is they're going to keep that asset because, we want to maximize our retirement income. And they may draw down on that asset in retirement, pulling money out, supplementing what they maybe need in retirement.
Okay, so we put a couple of case studies in this slide deck, basically, and we had John and Mary, and this was a true story. They had a combined income. They were both 45. Combined income more than $200,000. High wage earners. I believe she was a nurse practitioner and he was a doctor, possibly. But they needed life insurance coverage. Obviously, they're a couple. They were dependent upon each other. And they needed to set aside more money than they could in their regular. They had already maxed out their 401k. And they were concerned with the impact of earnings or the income on taxes on their income later on in life, because they are paying they're in the highest tax bracket now. And they have an additional $10,000 targeted for a retirement supplement. And this was kind of how it worked. We were able to purchase a whole life policy, like you mentioned, $10,000 as one of their cumulative contributions. Up to age 65, they continued to contribute to that $10,000 a year. So at age 65, they had contributed a total of $200,000 into this. At age 66, when they both retired, they were able to withdraw $30,000, just not a loan, but actually withdraw it. And they were able to basically supplement their retirement income with this money over time.
Mm-hmm. Yeah, what I like about that slide, it's a very honest slide. Because with whole life insurance products, you put money in the first year, sometimes the first 2 years, and you're kind of prepaying your life insurance death benefit for life. Notice how there's no money built up the first year. And a good advisor who's coaching people on this, tells people and coaches them that, look, this is a long-term financial tool. In the beginning, your cash value is not going to grow that much. You can look at when they're 55, they've put in 100,000, it's only grown to 115. But they have a death benefit which is 4 or 5 times that. So there's 2 rates of return actually going on here. There's a cash value rate of return, which is not going to make anybody rich. Over a 20-year period, maybe a 30-year period, you're looking at maybe a 4% return over time. But there are many people who will take it. But in your first few years, it's actually negative. But the rate of return on a death benefit immediately is incredibly significant, more than 30 times what you put in. And typically over a 20 or 30-year period, the rate of return on the death benefit is closer to 11 to 12%. So we need to look at the rate of returns separately, because if people have a good understanding of life insurance and how it can be used in retirement, it's not really the cash value which is important. It's leveraging the death benefit. And as we can see, they're retired with $339,000 of cash, but $666,000 of death benefit. And that is the real potential value for a retiree if they know how to use the product properly.
Okay. So now let's talk. That was more of like a Roth alternative, so an additional savings vehicle.
Correct.
Now, what about like a cash reserve? So we've heard that said. I've heard it said a lot.
Mm-hmm.
Let's talk to me a little bit about things that a cash reserve could pay for.
Well, typically we always want somebody to have an emergency fund, and we also want them to have an emergency fund number 2 for. It might be, as we see up on the screen, it might be tuition, it might be buying a car, it might be a wedding. We want a multi-purpose bucket. Many people, especially people who are accumulating assets, they want to minimize their taxes, and they also want asset protection. In the state of Florida, we can't speak for every state, but the cash value of life insurance is creditor and asset protected. So if somebody's putting money into this life insurance product, like folks were in the previous slide, and let's say they've got 50 or 100,000 in there, if they get sued, that money is protected in the state of Florida. If they need it, they can pull money out. They can pull dividends out tax-free if it's a participating policy. And they can use it for a different purpose. They can borrow against the policy, either as a short-term loan or a long-term loan. They can pay it back when they want. They don't even have to pay it back. But it is usually recommended to pay it back because you will be paying interest on that loan to yourself. But if you pass away and you have a loan on your policy, basically they just take that loan out against the death benefit. But it can be used for many, many different purposes, and you don't have to cancel the policy in order to use it. So it can be used as I don't want to say somebody can be their own banker. There were books written about this, particularly about 20, 25 years ago, about being your own banker, and I really don't agree with that. But in some cases, we meet with people, they don't qualify for loans at the credit union here at FAIRWINDS. Maybe they're over-leveraged, or there's something in their credit report that doesn't allow them to get a loan. But if you have money in life insurance, you have a guaranteed loan, and you can borrow that money from yourself.
Okay, that sounds good. Like I said, we did a couple little case studies. So this is Tom. He's 35 years old, and he has a need for life insurance. Now, he is single. And he makes over $150,000 annually. So if there's any single women out there, I'm just kidding. However, he is currently investing. He's maxing out his 401k, and he's got an IRA on the side. And he's really interested in starting his own business and purchasing a home. So he's 35. He's right at that life stage of things changing. So this is what. Go ahead. Will you?
No, this is a great example where typically people don't think of if you're single that life insurance can be. Can we go back to that slide?
Sorry.
If life insurance can be a financial tool, typically a question that comes up if you're single and you have life insurance, like my son who's 24. Who do you make the beneficiary if you don't have children and you're not in a committed relationship? Well, you know what? Make your parents a beneficiary because they spend a lot of money raising you. But in this case, this gentleman might use this cash value life insurance for tax purposes, asset protection purposes, and that multi-purpose bucket that they can leverage in the future. A couple of famous stories. Apparently, I haven't seen it in writing, but apparently Walt Disney started Disney borrowing from his life insurance policy. Mary Kay Cosmetics, I don't use their products, maybe you do, but She apparently also started her business borrowing against her life insurance policy. So if this gentleman is interested in maybe starting a business in the future, life insurance might be an asset that he can use. And in some cases, if he were to take out let's say a large business loan, he might be able to collateralize the life insurance in order to qualify for the loan. So that way the credit union or the bank issuing him the loan is comfortable doing that, because if he passes away because he gets hit by a train, they get their money back. So life insurance can be leveraged in many, many different ways, and very often for those entrepreneurial spirits. I have one gentleman who, over the years, put away a lot of money into life insurance, and he used that to build up about 5 rental properties. And he managed to buy and sell, and he kind of did his own little, be his own banker, so to speak. But the banks and the credit unions wouldn't issue him loans at a certain point. He was over leveraged, but he did it on his own, and he has managed to do very, very well. He got lucky. Some people not as lucky in the real estate world if we go back to 2008, but he did very, very well, and he used life insurance for that purpose.
I had not heard that about Walt Disney. That is interesting. I'm going to have to fact check that, but
yeah, I think that company's done okay.
I think so. Yeah.
150 a ticket, maybe? I don't know what
like
it is.
That. I just bought annual passes, so lots of fun.
That's the way to go.
All right. So, and this actually just shows what Tom does with his. At age 35, he pays a premium of $10,000. His cost of insurance is obviously cheaper, so he starts. It starts accumulating a little bit faster, but he's able to withdraw $35,000 in about 10 years in order to purchase a home, and then $45,000 to purchase a business in about 10 years after that. So that's how he used it in this situation that we have.
And I actually had a client who did something very similar. They started early, they put the money in, and if they can work with a what we call a participating whole life insurance company, typically every year they get a dividend that gets put back into the policy. Now, the dividend, taxation-wise, is considered a return of premium. So therefore, going back to this case study that I had personally, they had built up about $20,000 of dividends inside their policy. They just pulled out the dividend, and they used that for their down payment on the home, and it was tax-free because it's considered, per the IRS, a return of premium. So typically, if I am going to recommend a cash value life policy, without mentioning any names, I like companies that are mutual companies, meaning the policyholders are basically the owners of the company, so to speak, and they get dividends, which often helps their contract grow at a greater rate over time.
Right. Okay. And that was a question I was actually going to not off this slide that's up there, but basically you have the ability to work with many different insurance companies. You're not captive to one company per se. Is that correct?
Yes. One of the nice things about us at FAIRWINDS, we don't issue any life insurance products ourselves. So we're able to go out into the marketplace, and whether it's term insurance or whether it's cash value life insurance, or if somebody wants an indexed product or a variable universal product of some type, we can go out in the marketplace and then find a good match for those folks. But every financial tool has a pro and a con, and as long as they're being presented with 3 or 4 different choices, they can make an educated decision.
Okay, good. And for the audience, I just skipped over 2 slides, but those were exactly the same thing that we had said on the first slide. I just wanted you guys to be aware of that.
In terms of long-term care?
Yes.
Yeah, this is... We could spend an hour right here, and maybe this will be a future conversation. But you mentioned earlier about how your parents, your mom didn't get the long-term care. I was fortunate. The time to buy, there's about 4 or 5 different ways to handle long-term care, and buying a policy where you're paying $5,000 a year is becoming less and less common. One, if you get hit by a truck, that money is gone for the most part. So people are not buying them like they were 10 or 15 years ago. The products were cheaper then. There were many contracts where you only had to pay for 10 years and you were covered for life. So people are now looking at alternatives, and insurance companies are coming up with alternatives to a traditional long-term care policy to satisfy the need that people have for long-term care planning, and so they have confidence in their retirement plan. Life insurance can either have a long-term care rider, or most cash value life insurance products have something called an accelerated benefit rider, where if you become disabled, terminally ill, or lose 2 of your activities of daily living, which could be feeding, dressing yourself, you can get a portion of the death benefit while living for medical care or otherwise. People can also, if they have an extreme situation, you can also sell your policy. You can sell it for cash. And this came about in the 80s when we had the AIDS crisis. Now it's more of a chronic situation with HIV, where the medications are making more of a chronic disease. But back then it was, unfortunately, it was a death sentence. And people needed medical care, and maybe their insurance wasn't covering their needs. So companies started springing up, buying for cash life insurance policies. And it was a win-win for both sides, so to speak. And we know Wall Street even buys life insurance products because if there's a guaranteed payout. So those are called viatical settlements. And whether somebody buys a life insurance product that has an accelerated benefit rider or a specific long-term care rider, somebody could also sell the policy, get cash, and use it for whatever they want to. Maybe they want to spend their last 6 months traveling around the world. So it's kind of a morbid conversation here.
Right.
But for the most part, life insurance can be leveraged or used maybe to replace whatever is used for care. So let's say your mother, let's say her care turns out to be $120,000 over 15 or 18 months. And let's say she had to draw down some of her assets so that she was able to, the family was able to care for her. Life insurance could come in after the fact, if God forbid something happened, and replace that bucket so that the estate stays whole. So many different options, and there are more options now than there were 10 or 15 years ago when it comes to life insurance with a long-term care benefit.
Right. And the case that I put up on the screen just now, basically, she used the accelerated death benefit. She had a terminal cancer and was able to access the majority of her death benefit while she was still living, which helped continue and help her maintain her quality of life.
And dignity.
On this, and dignity, exactly. Being able to get the care that she wanted or she needed, able to make and the rest of her family at ease. Her husband was able to, actually go to all the appointments with her and be there versus having to work and maintain their income. They were able to access this death benefit. And this just really helps so many people, maintain that quality of living. Especially when they have a critical or a death sentence, like you said earlier.
Correct. And it also maybe keeps them in their home. Maybe they have a lot of their wealth in their home, and hopefully their home is paid for if they're in retirement. But this way, they don't have to move. Maybe they can get the cash they need, like I said, either through accelerated benefit rider, long-term care rider, or a viatical settlement in order to, take care of themselves.
Right. Now, I don't know if we have the slide up here. Oh, well, no, we have this slide. Basically, will it happen to you? I mean, this is really kind of one of those things. 7 out of 10 people turning 65 will need some form of long-term care at some point in their lives. That's huge. 7 out of 10 people will need some form of care in their retirement. The average 65-year-old couple will need as much as $400,000 for health care expenses in retirement. That seems like a large number. Is that a number that you typically see?
It's people are living longer. We know that the boomers, they typically don't want to move back in with their children. As a generation, the boomers are very independent, and their kids are very often dual working families and are unable to care for mom and dad. So planning for long-term care is very important. On a personal side, my father spent his last year in a nursing home. We did have, a policy which covered everything, and he loved it. It was he was able to get the care that he needed, and it actually helped my mother and the family tremendously. So planning for long-term care is important, and we do see that long-term care is typically needed more for women than men. Statistically, men typically, if they do go to a nursing home, maybe on average the stay is about a year. For women, it can be upwards of 3 years.
Right.
And I can just tell you, my father was one of about 4 gentlemen in a community of about 100 women. So he was very popular while he was there. But it is mostly women who seem to need the long-term care benefit. So if a couple is planning for long-term care and they maybe can't afford to have that coverage for both, I think it's important, just based on maybe family history and also genetics, so to speak, to focus on the female, because she's more likely to need the long-term care coverage.
And one of the statistics mentions that 1 in 5 of today's 65-year-olds will need long-term care for longer than 5 years. And I mentioned my grandmother before, and she is now going on her 7th year in this facility. So
yeah, it's it can be very expensive. We know memory care is the most expensive form of long-term care. That can be upwards of $9,000 a month, and obviously, typically people with that type of situation, they can be very healthy physically, but just in terms of Alzheimer's or dementia, whatever it happens to be, they may be very much unable to care for themselves. So it is important to plan.
Okay, well that's very, very true. All right, so we did talk about the accelerated benefit rider, but the long-term, there's a slide about the accelerated benefit rider, just kind of how it works. You can accelerate 100% of the death benefit for a qualifying chronic, critical, or terminal illness. Long-term care, though, you may not qualify for that. So a lot of times you may need an optional add-on to a life insurance policy that will provide financial benefits specifically for long-term care needs.
And typically what we're seeing with the life insurance piece, there is something called single premium life insurance. So let's say somebody has a lot of money in CDs at the credit union or at a bank, and it's just dormant money, maybe getting 1 or 2%, and they don't have any plans for that money. They could take 50, 100,000, 75,000, 30,000, buy a single premium life insurance product with a long-term care rider, and no matter what happens, no money is being thrown over the fence. Meaning if the policy is canceled, if it's within a certain period of time, I believe it's typically 15 years, you get all your money back. If you pass away, you get almost 2 times what you paid in. And if there is a long-term care issue, depending on the type of contract you choose, you might have a long-term care benefit 2 to 5 times greater than what you put in. Now, naturally, you wouldn't take all of your money and put it into something like this, but if somebody has dormant cash, something like that, a single premium life insurance product is very, very, very feasible, and for, let's say, people 55 and older. We've shown some slides earlier showing a 35-year-old, a 45-year-old putting $10,000 away, but what if you're 55 or 60? As long as they're healthy, and I believe you can do single premium life insurance with long-term care up to probably age 75. The benefits are lower, the longer you wait, but it's a very, very viable option for many people who are maybe missing out on some type of long-term care benefit.
Okay, well, thank you for that, Kevin. Now, before we go into questions, I just kind of really want to wrap up basically by saying, we talked about who needs life insurance, who needs supplemental insurance, or supplemental income. How will the savings be taxed? So we talked a little bit about taxation. How can life insurance provide protection and tax-free income? How is life insurance used as a cash reserve? And how can life insurance be provided for long-term care? Do you have anything else that you would like to add to the presentation today?
One item I didn't bring up. Very often as I work with retirees, one of the questions I do ask is there anybody in the family with special needs? And the reason for that is when people are retiring, it's not just about traveling the world. It's very often about taking care of their families. And if there is somebody in the family with a special need of some type, whether they're a grandchild or a son or a daughter or a relative in some way, life insurance can also be set up where it's a special needs trust, where this money at the passing of this husband and wife per se, this money goes into an irrevocable trust, and the only use of that will be to care and help care for that individual. And that's why if I were to say anything, if we go back to that little analogy of life insurance being a Swiss Army knife, a multi-purpose tool, if folks out there are able to work with an advisor who is knowledgeable not only in building wealth and the typical financial tools, but on incorporating products like whole life insurance or cash value life insurance, there's a lot they can do for themselves, for others, and maybe even for charities. And so I'll probably end on that. I think that's a good note to end on.
All right, sounds good. Well, we have a few questions today. And before we start the questions, I do want to let those who've asked, we'll send out an actual PDF version of the slide deck, but there will also be a replay that will be sent from the webinar jam that you registered for. So you'll be able to review it in two different ways.
Great.
Yes. All right. So question number 1, in planning for retirement. Now, this was around the Social Security slide. I believe that we got this one in. In planning for retirement, is it safe to count on receiving around 75% of what Social Security Administration says I will receive?
That is actually what it states on. We used to receive paper statements every year. If you're over age 60, you should be receiving a paper statement every year. But to save money, and we want our government to save money, you have to log on to ssa.gov, create a profile in order to view. If you read through that first page, it will talk about how it is fully funded to pay out 75% of the stated benefit. Now, of course, we know over time that things will probably happen where they'll get that back to 100%. And I don't have the paperwork right in front of me. I don't know what year that is, whether that's 2032 or whatever it happens to be. But I could see them raising full retirement age. Right now I think I'm 67 in 6 months. I could see them raising that to 68 in 6 months, something like that, because people are living longer and we want the program to stay healthy.
Okay. All right. The next question is there a life insurance product that once the term is up, you can at the very least receive whatever you have put in over the years?
Yes, it could be a cash value life insurance product that we've been talking about. And as long as you pay in for about 10 years, you'll probably get back every penny that you paid in. But there is life insurance out there called return of premium, where the company doesn't give any promises for cash value 20, 30, 40 years from now. But what they say is, hey, if you buy our life insurance and you pay, $1,000 a year for the next 20 years, in 20 years, when we cancel the policy, we're going to give you back 20 grand. What they really do is they double your premiums. So instead of that policy being $500 a year, they make you pay double, and then you get back that money. What a person would need to do is do a little analysis and say, well, if I just bought non-return of premium insurance for 20 years and took that other $500 and put it into my Roth IRA or some other type of investment, where do I think I'd be better off? And that's what you would need to look at. But yes, there are a number of different policies like that out there, and they may be suited for your situation.
Okay. Well, we just have a couple of minutes left. So I want to ask another question, the next question. Is this like this whole life or cash value life insurance, is it something that you should start by the age of 35? And what if I'm not 35 anymore? Should I play catch up?
I think it all depends on cash flow and budgeting. So when we're younger, like I said, the most important thing for me when people are younger, especially if they have children and a committed relationship in some way, it's more about how much life insurance there is. I'd much rather see a young couple with $1 million on the husband and the wife of term insurance with children, as opposed to whole life insurance on that same husband and wife for a total of only $100,000. Because if something happens to either one of them, $100,000 really is not going to help that family stay in that same home. $1 million that comes in can replace somebody's income. So I think that answers that question. But for the most part, it depends on everybody's personal situation. But cash value whole life insurance should be for people who are super savers, maybe maxing out some of their other investment tools, or for people who have a lot of dormant cash on hand who maybe qualify for single premium life insurance products. Nothing wrong with term insurance. Maximize your term insurance based on your family situation.
Okay. All right. One last question, I believe. I have a life insurance policy that I bought a long time ago. How do I know if the cash value is something that I can use? I've heard different things about life insurance.
That's a great question. With any type of life insurance product, if you're going to analyze it, you always need to call the company and ask for an in-force illustration. Number one, a lot of illustrations that were taken out a number of years ago, they used very, very, very exaggerated assumptions, thinking you're going to get 12% in that product. And that may not be the case today in today's low interest environment. So an in-force illustration is what you would want to ask for. It's free from that company. It'll give you an idea how healthy a policy is. And if a person has one of these, they should do this and bring it to a financial advisor who's familiar with life insurance products, and they're going to be able to tell you whether that policy is doing what it's supposed to be doing, or whether that policy maybe has some red flags.
Okay. Well, thank you, Kevin. This was a lot of great information. I've always enjoyed talking about life insurance with you. Thank you, Kevin.
My pleasure.
All right. Thank you, and have a great afternoon.
Have a good afternoon, everybody.